Today I would like to analyze UPS, one of the major shipping companies in the world, and I think it's an interesting buy right now. If we take a look at the stock price, we had a around 17% drop in a couple of days, and this is because they announced that they will cutting down the volume of Amazon shipments around 50%, and this is a big reason for the drop, I would say. The earnings were quite good. They had expected $2.53 earnings per shares, and they had the 2.75 earnings per share announced, so that's quite good. The revenue was slightly missed, so that's not good. But we're going to take a look at the financials to find out why this company is an interesting buy right now. The first thing we can recognize is a huge market cap of 96.48 billion US dollar. So it's the biggest company in the world about courier. We can see here the competition FedEx and DHL is smaller compared with the market cap. And we also have a dividend around 5.8%, which is very high. And we can see they did increase the dividend 15 years in a row already, and in a good, very good rate as well. We can see here sometime close to 9%, over 5%. Yeah, it's a very good rate. Now in 2024, the dividend didn't increase very much, around 0.62%. So, but it's looking very good about the dividend, and I think it's an interesting company. So the first thing we are looking for is revenue growth in the last 5 years. So you want to invest in a growing business and not a declining business. We can see here in 2019, the revenue was around 73 billion. Then we had a 14% increase in 2020. Then again, 15% increase 2021. Then close to 3% increase 2022. And now in 2023, we have a drop around 9%, which is something we don't like to see. But overall, we have a good growth, especially during COVID. And for me, it's a check here. We like to see that. The next thing we're looking for is free cash flow growth in the last 5 years. A very important number because the free cash flow can be used to pay the stock buybacks, to pay the dividend, to pay the debt, and to invest in the business. So we would like to see that grow. We can see here in 2020, it was around 5 billion. Then we have the very strong increase in 2021 to 10 billion. Then we have the decline around 13%. Then we have the decline again around 45%. And now we have the increase again in 2024 around 22%, which is something I would say is okay. We have the very strong year in 2021, so it's understandable that we have some decline from this. But overall, I would say we have the revenue growth in the last 5 years. So it's a check here as well. So the next thing we're looking for is free cash flow yield over 4%. This can also tell us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. What we're going to do, we're going to take the free cash flow in 2024, around 6.21 billion. We're going to divide it with the current market cap around 96.48. And then we're going to get the free cash flow yield for 2024. So the number we get is around 0.0643, which means around 6.43% in free cash flow yield, which is very good, I would say. And it looks like the company is undervalued about the free cash flow. So it's a check here. The next thing we're looking for is debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number because if a company has too much debt, it can risk to go bankrupt. We don't want to see that. So what we're going to do now, we're going to take the short-term debt around 4 billion. Then we're going to add the long-term debt as well. So the long-term debt is around 22.67. And then we're going to divide it with the free cash flow that we had in 2024, around 6.21. And then we're going to get the debt to free cash flow ratio. So the number we get is around 4.29, which is a very good number. In a little bit over 4 years, we can pay back the debt with the free cash flow. So it's a check here, and we like to see that. We also can take a look at the cash on hand, how much money they got in the bank. We can see here around 6 billion, which I think is a good number as well. They can use this to pay the dividend, to do stock buybacks. We can also see the cash on hand was the highest in 2021, but it's still a good number, I would say. I think the balance sheet looks very good actually, so we like that. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. A very important number as well, because if a company buys back their own shares, it can help the stock price to increase. And we like to see that, especially we think the company is undervalued. And we can see here UPS did a lot of buybacks many years in a row. We can see especially here since 2012. And then we also had some increases in 2020 and 2021. I think it makes sense as well, because I think at this point probably the stock price was very high. So it makes sense to increase the shares outstanding. But now we can see again 2022, 2023 and 2024, they did buy back their own shares. This can help the stock price to increase. And especially if we believe the company is undervalued, we really like to see that. So it's a check here. And I think it looks quite good. I would like to give my conclusion about this company. So let's start with a positive. So I believe they are in a growing business. The e-commerce will still be important in the future. And I believe e-commerce will grow a lot as well. So they can have the profit from this business. Then the high free cash flow yield around 6.42% is looking very good as well. I think it looks undervalued. They have a good balance sheet as well. Low amount of debt that they can pay with the free cash flow, and a good amount of cash on hand. Then the high dividend yield around 5.8% looks very interesting as well. They did grow this dividend many years in a row, around 15 years in a row already, and this looks very interesting for me. I also think this company maybe have some competition with Amazon and other shipping companies, but I think this company still have a strong market position, and I think they can still be the very dominant company in the future. I think this company looks undervalued, and I believe it's a good buy right now. I think around $113 is looking very cheap, and I believe it could go up to the $130 again. And I think maybe in the couple next months, this company could be at this level again. And I think then is maybe a good time to sell, or you invest for the long term as well, because this company just looks cheap actually. So I think it's a buy right now.